Welcome everybody to the Catalyst Funding Real Estate Market Update for April 2024. I just want to let you know we'll be starting shortly. Thank you everybody for joining us today. We'll be kicking off here in about 30 seconds.
I think we're 12:01. Let's roll.
Let's roll. Okay, great. Well, here we are at the market update. I'll introduce our Catalyst founder and CEO, Wade Comeaux.
Hey, everybody.
And our Director of Lending, Jeff Johnson.
Hello.
And we'll get ready to get started.
Awesome. We can go to the next slide. Yeah, so unfortunately, Steve Curtis is not able to be here today. Steven has moved to NRL, which we are announcing on the webinar today that Catalyst is also moving to NRL. Steven is in a leadership role. He's Chief Production Officer now at NRL, so that does involve a lot more responsibilities. And at the very last moment, he and the CEO of NRL were pulled away to Florida. But he was very excited about being here today. We'll get him on a future webinar. But I do want to talk a little bit about Steven and NRL and our move so that you guys can be aware of how that's going to impact Catalyst and our borrowers and the referral sources and other partners that we work with. So Steven is the Chief Production Officer there. Steven and I have known each other for almost 25 years now, worked together with each other at many different times. And we worked together briefly at the Security National Mortgage Company as well, where my team was, Jeff was, for about 6 years. But we're very excited to move to NRL. We had a great time with SNMC, nothing bad to say about that group whatsoever, but we are very excited about some of the differences here. And I'm going to cover a few of those and how it can impact you as a borrower or maybe you as a partner that works with us. I'd say some of the biggest differences are that it's a Houston-based company. It's very Texas-focused, and we are very Texas-focused as well, obviously. And I think that local flavor, local expertise, local passion is really going to help us provide even better customer service, faster turn times, and more understanding and expertise in this particular area. They also have a real passion for extremely fast customer service. Like the other day, we had a challenge, and it was literally able to be rectified within an hour because of a relatively flat organization. You know, I know Steven very personally. I know the CEO. He's very deeply involved with our onboarding and ensuring that everything goes smoothly. So I think that we're really going to be able to help customers in a quicker way. And then another big passion that they have is just not getting beat on price as a normal course of action. Like they're very passionate about providing value beyond price, but also providing very solid pricing. And we have been had just an overwhelming amount of recent applications as we're telling borrowers how much more attractive the price is in all categories, from owner-occupied transactions, both purchases or refinances. Especially a lot of people right now are doing those cash out refis to fuel their real estate investment goals, but even more so in the non-owner occupied space. I mean, we've been quoting deals that are probably 150 basis points better than we were able to quote not too long ago. So I think that that's an incredibly strong offering, and I think that we're really going to be able to help people, because in this moment when there is rate pressure, the toughest thing to get at the moment is cash flow. It's very easy to get equity capture. There are great deals out there as far as getting equity capture, because you know, the prices that people are offering are coming down, because investors are offering are coming down because they're not getting quite as much cash flow. So the equity capture, Jeff, you've seen it, it's really strong across the board on the deals that our borrowers are doing right now. But this reduction in price is really going to take that cash flow that might have been $50 and make it 100. Maybe it was 0 and making it 100, or like the changes are different, very different whenever you can get that much better of a price. Jeff, what else are you seeing that I think our borrowers should know about?
Yeah, so I was taking some notes here. So I think a couple things, just to restate for maybe some of you that aren't familiar with the setup. You know, Catalyst is still Catalyst. We do all of our hard money loans in-house. You know, we underwrite, fund, everything is done in-house for hard money. What we're referring to is our long-term conventional partner. So for buy and hold investors, we still have a bridge product. That is something we're very passionate about. That is still intact. So if you're familiar with us and familiar with the bridge product, that's still there. Sorry. Number two, obviously they do, if we have regular conventional loans that are not investor focused, if you wanted to pull cash out, like Wade said, they have the price match guarantee. I mean, I sat with the one of the higher ups, probably number 2 or number 3 in command, and he said basically, I will not compete on price. Like they're very passionate about that. So we're very excited about the ability to price these deals. Just anecdotally, in our short time there, the folks at corporate and the support group are super responsive. And so that's, responding to us, but also that kind of permeates throughout the culture, and they have a desire to really be the leader in that space. And I'm talking about mostly customer service. Like they want to be the go-to for folks that want to do buy and hold, right? Long-term stuff. They are really focused on having a positive customer experience, getting these deals closed and processed fast, so you can get out of hard money and get onto your next deal. So I'm very excited about our move. I think if you work with us in the past, hopefully you had a good experience. Should be even better now, but we're very excited.
Yeah, I'll tag on to 2 things you said there, Jeff. You said that we still had the bridge appraisal, which we definitely do. To give a little bit more clarity on that if you've ever been in a transaction where on the refinance, the appraised value comes in less than it did on the hard money, or if you purchase for cash, that's not uncommon. The second appraisal is a regulated appraisal on a conventional loan, and we're on a DSCR loan. Those are something called air compliant, so they're heavily regulated. And on hard money appraisals, that's an unregulated space of the business. Or if you just bought it for cash, there may not even be an appraisal, or there may be an appraisal through a private lender that's also unregulated. So there's often a reduction of value on that second appraisal. With NRL, we're able to offer something called a bridge appraisal product, where you're able, for all intents and purposes, to use the same appraisal on the long-term loan as the short-term loan, which is really reduces that risk. As long as there are some caveats, don't get me wrong, it has to be done within 120 days, some other things, but it's an excellent product for reducing risk and reducing that out of pocket that you have on both the first and second transaction. And we really try to look at the out of pocket as the dry powder that you have to create your financial future. And if we can help you use $100,000 to buy 4 properties instead of 3, that's a powerful difference in changing your financial future. So your cash out of pocket is a big driver there. Now, we are able to still do that on conventional loans. A big change with NRL is that we're also able to do it on DSCR loans, which is a real positive. So if you are unable to qualify for conventional, you've already done 10 conventional loans, or you may not have relatively documentable income and you need to use a DSCR, which is a no income doc loan, you can also use the bridge appraisal for that. So that's a very exciting development as well.
Yeah, and I'm sure, I spoke with a lot of folks that are new to investing, and they say, yeah, I want to be a buy and hold investor, but I don't have a job that pays me a W-2 salary, so I can't qualify. So I can't be a buy and hold investor, right? They think they can only flip. And that is definitely not the case. If you don't have documentable income that would qualify you for a conventional loan, there is a world of non-conventional called DSCR, debt service coverage ratio loans, that will allow folks that are self-employed, or maybe they don't even have a job, you just built up some savings and you're trying to invest, you can do these loans as well. So it's a great product, and if you don't know about it, give us a shout, and one of the loan officers can explain it to you.
For sure. All right, let's go to the next slide. The disclaimer here is that we're providing this for general information only. Catalyst cannot be held liable if you make investment decisions based on any of the information here. It's just purely for information. We're not giving investment advice. Next slide. So we talked a lot about this. I'm going to hit a couple of highlights we didn't cover earlier. We do want to be that one-stop shop for both hard money and permanent financing. I want to explain what that means. You'll have a single point of contact, one loan officer, who can be your loan officer for both hard money and permanent financing. And with one credit pull, you can get qualified for all of those products. So you don't have to pull credit with Catalyst Funding and with the Catalyst Group at NRL. It's one credit pull that can facilitate both those transactions. And another big part of that is that if you're wanting to just get pre-qualified, let's say you don't have a property yet, you want to know, what's my pricing going to be on hard money? What LTV can I qualify for? what is going to be the refinance rate on a DSCR loan, or refinance rate on a conventional loan. You can get all of that information with a soft credit pull. We're very passionate about protecting your credit rating and allowing you to have the best possible credit rating, because that impacts price, that impacts dry powder, how much money you have to put into each deal. So we really want to protect that. And then the other thing is that we're real estate lenders built by real estate investors. Most of the people on the team have been involved in real estate investing. You know, I personally and another entity own a pretty large single family rental portfolio. So we're passionate about this business, and we try to help you succeed with that experience. That's all I have to cover there. Let's dive into the next slide. And Jeff, why don't you tell us about what's going on in Houston?
Sure. So I'll run through the stats. In March, there was roughly 3.5 billion in volume, as opposed to last March, 3.7. 5 Marches ago, and if it seems like an arbitrary number, it's not. That is basically pre-COVID numbers. You know, COVID had a large effect on a lot of the real estate run up, and so we always want to give a lot of perspective for those folks that aren't on here much. That is our pre-COVID number. So year over year, down 5%. If you were in the market, you know, over the past 5 years, it's up 45%. Listings are up quite a bit, flat relative to 5 years ago. Sales are down slightly. So the listing to sales number, it's a lot lower than it was. Again, pre-COVID number, even those numbers are almost identical. If you look at March 19 and March 24, the number of listings and the number of sales is almost identical. Average price, the price was up 1.3% to 412. 5 years ago, the average was less than 300. So you bought an average property 5 years ago, doesn't even need to be a home run, just average. You gained over $100,000 in equity just from buying a property 5 years ago. And there was somebody that we were helping with a deal, and the appraisal came in, I just wanted as an anecdote, the appraisal came in slightly lower, I think $5,000 than they expected. And they were giving serious consideration to backing out. And if you really think about it, you're talking an extra, on a $5,000 appraisal, you're talking an extra $3,700 out of pocket. And while in the moment, you know, another $3,700, that may seem like it's over the edge to push you from a good deal to a bad deal. But if you step back and think about it, especially if you're a buy and hold investor, and you look at these numbers, like, okay, I'm gonna buy that property, I'm gonna pay an extra $3,000, but in 5 years, I'm gonna make over 100. It really clarifies the decision for, in my mind, and I'm presumably for most folks, those small numbers, those small variations in what you expect versus what reality is, in the moment can seem like a big deal, but if you look over time, it's a way better situation to buy that property than not. Sorry. Months of inventory, 3.5, up almost a full month over the last year. 5 years ago, it's slightly less. Pending sales are pretty flat, up 5%, and days on market are down to 55 days. So Houston has been very resilient over this last couple of years. It hasn't had the run up as say in Dallas or in Austin. It's had a much more steady growth. And there's a couple of slides we'll look at later, but as far as bang for your buck as a buy and hold investor, when you look at rents relative to the prices of these homes, this is probably your best market to buy a property in. Wade, I don't know if you have anything to add or.
Yeah, I would just say I'm always looking at the months of inventory and days on market as leading indicators of where a market's going. You know, that's probably the best way to get ahead of potential price changes. You know, like Jeff said, prices are way up since COVID, up year over year. Those are very good signs. But if you look at the months of inventory, it's still, you know, March 2019, that was a normalized market, right? And months of inventory is 3.9. Now we're at 3.5. Definitely, it's more months of inventory than, you know, that COVID era, whenever things are kind of flying off the shelf, but we're not in that time anymore. And that was a very unusual time, but still better than a stabilized market. And then days on market way down from pre-COVID, and even down from you know, that tail end of the COVID era in March 2023. So overall, what I would say is that Houston is a pretty stable market, and what we've been beating this drum for a while. If prices have not come down whenever rates are this high, What are they going to do whenever rates go down? I think you're going to see a huge jump in prices as soon as rates come down. There's a lot of pent up demand. And I actually saw an article recently that a lot of people are getting off the fence both on purchases and refis. The refi market is booming relatively to where it's been. I'm not saying it's crazy like it was in the COVID era, but refinances are increasing because people are starting to get more adjusted to the current rate environment. And really, we'll talk about this a little bit later, but the predictions of rates coming down anytime soon just don't seem realistic anymore with the new latest inflation numbers.
Yeah, there was a chart we showed. It was a few months back, I think. It was basically, and maybe we need to hit it maybe once a quarter, but it was like the chart that showed the percentage of mortgages that were above or below a certain number. Like like if you know 100% of the mortgages, how many of them are below 3, below 4, below 5, et cetera, et cetera. And I'd be really curious to see that chart maybe every 3-4 months.
Yeah, sure. All right, let's pop over to Dallas, which without question has been the highest appreciation market, but it is slowing down a bit recently, so it's a little bit interesting. You know, if you look at that pre-COVID number, they blow every other major market in the Texas area by a large margin. You look at average sales price pre-COVID up almost 60%, median up almost 52%. So that's a very interesting number compared to everyone else. You know, Austin was the front runner for a long time before the rates changed, but now they have come down quite a bit. So that's very interesting. Total volume is down just a little bit year over year, still pretty steady volume. Overall total active listings down from where it was in a stabilized environment, so that's still a pretty solid number. Look at months of inventory, down pretty significantly from that pre-COVID stabilized environment, and days on market also down. So overall, considering the rates, both Houston and Dallas, pretty strong overall markets. Now, I will say in both average and median sales price in Houston, there was no area that was down. It's kind of interesting, this statistic here. The average sales price is up 5.4% year over year, and the median is down 3.4%. I know we were looking at this the other day, Jeff. What does that say to you?
So I look at Dallas, and it's almost like a little bit of a mini Austin. It had a nice run up. It hasn't had the peak and the crash that Austin had. I'm not sure what to make of the slight drop in the median versus the this year versus last year. I think the difference, the spread between the average and the median is so large. I think it's just you're seeing a widening of probably there's not a lot of deals in the sweet spot, right, in Dallas. Now this may be just Dallas proper. If you go into the northern counties, I think that's where we're seeing a lot of folks taking advantage of the Dallas market and getting good rental properties. You know, we lend all the way basically up to Oklahoma, and a lot of our borrowers and the agents we work with are getting deals in the surrounding areas. Dallas is still a great market. If you look at, there's a couple slides, people moving in, like Dallas is booming. It's still booming. Like there's tons of people moving in. So Dallas is a great place. I'm not, like I said, I'm not sure what to make of the drop in the median this year or this month, year over year. But as far as I'm concerned, it's if you look at the pre-COVID numbers, it's got the highest run up, even including Austin. For the last 5 years, its average sales price is up 59 and 53. We get to Austin. Austin's up, but it's not up those numbers. Like Dallas has been the #1 market in Texas for the past 5 years.
And just kind of looking at the statistics, my assumption is that, you know, the median's down a little bit and the average sales price is up. I'm assuming that there's a lot of high-end homes that are being sold that are, I mean, I don't want to say a lot, but there's high-end homes that are greater of an impact to the average than the median, right? Because there are some really high-end jobs coming into Dallas. We see these corporate headquarters moving in, very high average income jobs. And whenever we look at the affordability index at the end of this report, areas like those small cities north of Dallas, like McKinney, where a lot of those corporate headquarters are based, the average income is extremely high, right? So I think that's an impact as well.
Yeah, a lot of white collar jobs.
Yes. All right, so San Antonio is next on the chart.
So I'll just run through San Antonio. Active listings year over year are way up. Sales are flat. If you look at pre-COVID, again, listings are way up, and I think the number of listings probably has to do with population growth in San Antonio. Like if I look I bet if you look at population 5 years from now, 5 years ago versus now, it's pretty significant why there's that many more listings. Average sales price is up 1% year over year, up 42% over the past 5. Median sales price slightly down, again up 36% over the last 5 years. Months of inventory, it's at 4, which is the longest of that's the most of the 4 majors. So it is it is starting to stack up a little bit in San Antonio. Pending sales 2,700, so there's fewer pending sales. And then lastly, 79 days on market. San Antonio, Austin, we'll get to Austin. Austin's very similar with days on market. I think Central Texas, San Antonio, and Austin, they've had a bigger run up, so it's taking a little bit longer now. They're kind of coming back down. The properties are lasting longer on the days on market. So I don't know. I will say this before Wade gives his note. I wanted to give, if you're investing in San Antonio, first of all, it's still a great market to buy. And don't get me wrong, very affordable. You can get rents not quite as juicy as Houston rents, especially relative to the price. If you look at the price of a house and the rent, and then you see San Antonio price of it, I think Houston's better. San Antonio is clearly number 2. But just as a tip for our investors in San Antonio, I think we talked about it last time. The strike force, San Antonio. A lot of folks, they do or don't get permits based on location, the kind of rehab they're doing, etc. San Antonio has basically a citywide, they call it a strike force, but basically folks looking online for properties that are listed for sale or maybe listed for rent. And if they see rehabs, they're checking permits to see if they were pulled, looking at the properties, and they're basically red tagging these properties to make sure the permits were pulled or they will be pulled. So when you're in San Antonio, definitely need to get your permits. We require it from our borrowers and doing deals in San Antonio. It just makes sense. It's a little bit of money up front. You deal with it, but it's way better than finishing your rehab, getting popped, and then having to destroy a lot of the work you just did and paid for to satisfy the city, because you can't do anything until it's cleared. Like there's no way around it. It has to be finished. So, Wade, I don't know if you had any comments on San Antonio.
Yeah, I'd just say, we don't just do it to protect our interests. We do it to protect our borrowers' interest, and it's just a no-brainer there. It's a minimal cost relative to the downside. And, I think it's taken a little bit of time for some investors to adjust there, but the savvy investors are always nimble and have figured it out. The other thing I want to talk about is just the price point of San Antonio. Whenever you look at the average sales price being at $370 and the median being $310, with comparable amenities, good job opportunities, and other things like that, that's a very attractive overall price point that I think, we've seen a lot of national prognosticators talking about how San Antonio may have the highest appreciation profile of any major market in the country. So I do think that there's a lot of appreciation upside there. It is a little bit slow at the moment, but I think the long-term prediction is very good. Look at the average sales price in Dallas, average and median, 500,000, 400,000. Houston, 412, 330. So it's definitely a very attractive price point there in San Antonio relative to the size of the city, the amenities, the job opportunities.
Yep.
All right, Austin, as we talked about, definitely the biggest run up. They are pretty much flat year over year on the median price, 450. And you look at that, relative to Dallas, there was a time about maybe a year and a half ago where the average price in Austin was greater than the average price in Dallas. Now the average price in Dallas is 50,000 higher. So that's kind of an amazing story. That's tell two things, right? Austin pulling down, and then Dallas just continuing a very torrid pace of growth. So the other things in Austin that you look at are just the same story as we had in San Antonio. Months of inventory. You look at pre-COVID, 2.4 months. Last year, 3, and then this year, 3.8. The days on market also up considerably from pre-COVID, flat with last year. But those are indications of a slower market, and that's just the simple reality. I know somebody who's selling a home in Austin currently, and the times of multiple offers, the first couple days you put it on the market, that is not the scenario now. It's still a pretty solid market. Home prices aren't dropping like they were about a year ago or even 6 months ago. So it is stabilized, but you just need to be cautious in that market. Overall, we'll say, give me one more second, Jeff, I'll turn it over.
Yeah.
And whenever you look at those national prognostications, which we regularly do, both San Antonio and Austin still have an excellent profile for long-term growth. And that, ironically enough, I think both of them are listed because of the slight pull down is having more upside going forward. Because normally once something starts to correct, there's often an overcorrection. Like the pendulum does just not stop perfectly. So I think that's why, as far as appreciation, really good profile for both San Antonio and Austin.
Yeah, I mean, it seems crazy to say, but Austin's almost turning into a bargain at this point. And San Antonio, we talked about it. It's for the last, I don't know, 6 months, it's been listed as one of the most like up and coming top markets to buy in. The one thing I wanted to note, I look at Houston and Dallas, and we sing their praises. Their days on market are in the low to mid 50s, and then you look at San Antonio and Austin, they're in the 79 or 80, which seems like a big difference. But in reality, if you're an investor trying to say flip property up there, it's really one extra month. I mean, it's not like you can't go and make money on these deals. You certainly can. You buy them right, you're going to make money. It's just you need to say, okay, it's going to take me one extra month to close this property than it would if I were investing in Houston or Dallas. Still, great markets, especially relative to the national scene. A lot of buyers. It will sell. You just got to run your numbers with an extra month. That's all.
Right. No doubt. All right, let's go to the next slide. And, supply and demand is what drives prices. That's the most common economic truism that's out there, supply and demand, right? And whenever you look at what impacts supply and demand, it's the number of people looking to buy homes, right? And one thing that has really driven very stable housing markets in Texas, and especially in the major metros, is the number of people moving in to the state, and especially these major markets. And it's really, I mean, if you look at Dallas and Houston, like they are literally more than double any other major metro in the country. And this is the top 10. This isn't like a broad list of just random. This is the top 10 gaining metros. And you've got Dallas at 152,000, Houston, Greater Houston 139. Next is Atlanta at 68. And that's pretty amazing.
Yeah. No. When I saw this chart, I mean, even Austin, like Texas has what, 4 of the top 10. You look at the state by state, right? It makes sense if you follow the national news and trends, like states like Texas, Florida, Georgia, the Carolinas, Virginia, Arizona. Like those people are moving into those areas and moving out of places like California, New York, the Midwest, etc. But I was just struck at like the difference between 1 and 2 and the rest. Like if you look at 3 to 10, 68 to 43. Right? That's relatively close. And then you have these 2 up there that are double the next highest, almost. Now Dallas is double, and Houston's pretty close. The next highest number, right? It's just the amount of people that moved into Texas this from 22 to 23. So I guess it's almost 2 years now, but still, that is a shock to the system. And it just indicates that the real estate market should be very healthy with all of this influx. People need a place to live, whether you're doing buy and holds for apartments, houses, whatever. It's a good time to be in Texas.
For sure. Next slide.
So I'll cover this briefly. If you look at it, it is a chart that says new and existing inventory. Starting in, it looks like 2010, I guess. So the blue line is new construction and the red line is existing home. If you notice, the existing home inventory relative to the new construction inventory passed over around, I guess they crossed the threshold around 13. And new construction has had more inventory for quite some time than the existing. Basically, I'm kind of curious to see that that red line is kind of trending up. So, what this tells me is until rates drop, you're going to have an inventory problem. People that have those 3s and 4s, they just don't want to or can't afford to get out of that house. And that mortgage, if they have a mortgage and they can't pay cash for the next house, they're going to go from a 3 to 4 to a 7, right? So you're going to have those problems. People just aren't going to want to move anytime soon until rates drop. So that means if I'm a new builder, I'm taking advantage of that, right? Because you don't have to worry about the supply side of the existing home. People want to buy homes, and if sellers aren't listing them, then you're the only game in town, right? So it's just, I think this is more so an effect of interest rates. Plus, they just haven't been building houses for quite some time now. But I think this is really an interest rate chart more than anything else.
Yeah, well, I think a couple things happen, and I do expect this new construction trend to start to go back up. But what happened, if you remember, rates were really low, like at the beginning of this COVID era. Everyone got panicked, and there weren't a lot of new permits. But this is a 9 to 15 month process to get a new home built, and that's after you go through the permitting process. You got to find land. It's an elongated process, so this is a lag. And I think whenever rates went up, there was a lot of panic. Is that going to crush the housing market? A lot of people, smart people, thought that might happen, but it hasn't, right? It hasn't at all. So I do think that trend is going to start to go back up, but it's always lagging. So I would expect, while that trend is coming down, it's going to start to trend up relatively quickly, but there's always that lag. So the great thing is that if you're a flipper, you can move more nimbly. So if you think about it, there is demand for homes right now, and the days on market is still lower than a stabilized market. And if rates come down, it's really going to get better. But there's not that many houses on the market. I know quite a few people looking for homes right now, and there's just a very, very limited supply. And if you're a quality flipper and you put out a quality product, you may have a little bit more days on market. The rates aren't fantastic, but there are people who are very interested in buying homes, and there's just simply not enough inventory.
That's a great point.
All right, let's go to the next slide. Housing supply shortage. So this is measuring each major metro, and we're talking about the rents in each major metro. So we're talking about Texas major metro median single family monthly rent, seasonally adjusted annualized rate. So if you look at the rents in each of these markets, you can see some trends here. You've got, as Jeff mentioned earlier, San Antonio has the most attractive rent. So I would say that means that there's upside there, because it is a pretty robust economic and job market. Then you've got Houston next. But if you look at it, whenever it started several years back, Houston was right in line with Austin and DFW, right? It was pretty much, they were all above San Antonio, but they were relatively in line. And then, both Austin and DFW have just continued to go up very, very aggressively. So I'd say a couple things there. I think Houston has a lot more upside, a lot of ways to go. And I think that in the DFW market, Austin and DFW, a big reason that people are more easily able to raise rents at the moment is because the housing prices are so high, right? So I think that is definitely impacting it. But that trend is interesting, that you went back as recently as, looks like maybe 2012, Houston, Dallas, and San Antonio were all pretty much aligned. There was even a time whenever Houston was above.
I was like, it looks like 15 or whatever, 14, 15. Looks like Houston was actually had higher rents than DFW. I look at this and I just compare these things to the prices of the properties. Like, if you're looking at Austin and Dallas, the rents are the same. Houston and San Antonio, it seems like it's in line, right? You're going to get a little cheaper property in San Antonio, but you're also going to have a little bit less rent. I think the difference in price in Houston and San Antonio is smaller relative to the difference in rent. It seems like you get more rent in Houston relative to your price than you would in San Antonio. That's why I said that, but the Houston's probably the best. But again, the relative to DFW and Austin, they're way better. But again, I look at Dallas, and you get outside of Dallas proper, and you get into the suburbs and a little further out. That's when you get some really good buy and hold opportunities. A lot less cash out of pocket.
Yep. All right. Next slide.
So this is went wrong way. So this is Metro Median days on market. I mean, we covered the days on market earlier in the call. Like we said, Houston and Dallas are in the mid 50s. San Antonio, Austin are closer to 80. This must be a little bit of a lag. Now, see, I don't know if seasonally adjusted maybe has something to do with it. But you can see right now, Austin and San Antonio, like I said, at the top of the chart. Houston and Dallas are running neck and neck. Historically, it looks like everyone's been kind of top or bottom. I would say San Antonio maybe has consistently had the highest days on market until you get to about 17 or 18, then it's in line with everywhere else. But it's just kind of a longer time representation of what we were discussing on the markets, right? Houston and San Antonio, Houston and Dallas, you can get them a little quicker than San Antonio and Austin, but still, within 30 days, I don't think it's that big of a deal, to be honest.
For sure. Let's go to this next slide. I don't have anything to add there. The down payment slide.
Yep.
So I really like this one. So if you look at it, and this is why investing in Texas is powerful. We're often talking about that. And if you look at this slide, Derek found this is really interesting. It's from the Visual Capitalist, and it talks about the average per state down payment. So you look at Texas, where it ranks, 18.8K, right? And you think about what's going on in that state, job market, average income, all these other things. And it's really incredible because the amenities, sports teams, entertainment, restaurants, all these things in the state of Texas are pretty incredible. And you look at the other states, it's basically in the realm of, and it's just not even comparable. Yeah, the other states with major cities like that are all on the far right side. The average, where the average out of pocket, California, 84,000 versus 18.8. That's incredible. Washington, 86. New York, actually a little bit lower than I would have thought at 50, but still larger. Most of the East Coast is in that, 80 to 50K range. And then where Texas compares is really pretty surprising, like Kansas, don't get me wrong, Louisiana, Mississippi, and Alabama are far lower, but you don't have anywhere the education system, the job market, the economy, any of those things in those particular states. But really, if you think about why people are moving here, amongst many reasons, but a big one is you can get a home for 18.8K out of pocket versus literally more than 4X in many of these other states with comparable jobs, comparable amenities.
Yeah, I just look at if you start, and it's kind of hard to read, but if you start at the bottom left and work your way to Texas, there's about a dozen states there. And so those are the cheaper states, less out of pocket, but they're I can't think of one I'd rather live in. No offense, but like if you look at the amenities, the jobs, the opportunities that are there, the quality of life, from Mississippi through to Kansas, even my dearly beloved Oklahoma, it's just not as great as Texas, right? Texas has a lot to offer, and it's still in the bottom third for sure as far as cost to buy a house.
Yeah, pretty darn attractive. Lots of upside. All right, next slide, Jeff. You'll take that one.
So this is kind of a little bit of what we were talking about previously with the home builder confidence. It's basically the article says builder confidence in the market for newly built single family homes climbed 3 points to 51 in March, the highest level since July of 23, the fourth consecutive monthly gain for the index. A score of 50 is considered a break-even point. So I think we're above that. So above 50 means home builders are feeling good. It was way up for a really long time. It crashed right at the beginning of COVID, it looks like. And I think the recent crash is probably interest rate related, just a little bit of a panic on their end, trying to wonder what the heck's going to happen. But like I said earlier, Rates stay where they are. People don't want to leave. Wade was talking about how there's just not as much inventory out there. That's great for the home builders, right? They're the only game in town right now. So this doesn't surprise me. I think this will keep going up until rates drop.
Yeah, for sure. All right, next slide. This is talking about apartment supply and how there are a lot of properties coming on the market. And you'll hear Jeff and I and a lot of the other people that we bring on talking about how following the multifamily investor, which is often, a corporation or very intelligent group of people that are pooling money together. Either way, they're a very good trend to follow. And despite the fact that the numbers are just as challenging as they are in the single family space. Interest rates are higher, insurance may be higher. They're building a lot of apartments to meet demand, right? Because they know that one, if they can make the numbers work now, there's only unlimited upside from here. Opportunities to refinance at a lower rate in the future. And then the trend that rates are going to have to increase, but rates always lag property increases. So whenever I see this chart, it is exciting because you know that these are very intelligent people that are making the decisions, multi-million-dollar decisions, sometimes $10,000,000 or hundreds of millions of dollars. They're often involved in these projects. So very good trend there. But then I also like this on the right side, despite the fact that it's increasing, the Multifamily Housing Council says that the U.S. needs to build an additional 4.3 million units by 2035. So just a lot of people coming to the country, a lot of population growth, and that, it's going to need to be housed. And that means opportunities for everybody on this call.
Yeah, I think the bottom line is, like to your point, people are coming to the country, people are growing up, and as the affordability to buy a new home is pretty high, they got to go somewhere, right? So you got to move out, you got to graduate, you got to find a place to live. So I think that's why they're seeing so many opportunities. Like, people need to find a place to live. Like we just said, they need to build another 4 million units in the next 10 years to meet that demand. So while these are apartments, that also means, people that maybe have young couples with a family, they need to rent. If they can't afford to buy a house, they need to, maybe they don't want to live in an apartment. Maybe they want to live in a neighborhood, they have a family. So I think the market for renters will remain robust until housing affordability drops significantly. Next slide. And this kind of speaks to that. Derek, there's a great chart. You did a great job of finding it. So first-time buyers must make $76,000 to afford the typical U.S. starter home. And so that is up 8% from a year ago. And if I'm reading this chart correctly, back in 2019, so that's when we started comparing numbers, the income level that was needed, this looks to be what, maybe 40K in that range. So it's almost doubled. It is almost doubled. Maybe my little grid estimate is wrong. It's roughly doubled in the past 5 years, the amount of money you need to make to be able to buy the first starter home. So it's just more of the same, like we've been talking about. It's getting really expensive to buy a property. And so that's for real estate investors. If you can find deals, buy properties, there's less out of pocket these days. You should have a robust and healthy renters market where you can hopefully charge more, be more selective with your tenants, right? Nothing's worse than getting a tenant that either doesn't pay or to evict. It's great to get, young families maybe want to live in a house for 5 years, right? So I think you're going to see more of that. If you're looking to be a buy and hold investor, you're going to have a lot more to choose from when it comes to tenants.
Yeah, just another factor saying rents are going to increase over time just because rents lag, right? Rents always lag. All right, next slide. So this is a national home price year-over-year forecast, and because earlier this year, most people were saying there may be 3 rate reductions this year, and that is not the consistent sentiment anymore because of the inflation number. So that's less likely for sure. but home prices are still predicted to go up nationally. And that this is, keep in mind, a national forecast. Texas is always going to be above that because the population inflow and affordability. So it's actually pretty exciting that one of the biggest prognosticators right now is saying that they anticipate, home price growth, but that is going to drop to 3.1%. So that's an important thing to notice in the comments to the right. It's not saying that home prices are going to drop by 3.1%. It's saying it's going to grow 3.1%, but not as much, right? Yeah. Okay. Next slide. So this is talking about interest rates, and this is one important point that I want to make. If you remember a few months back, rates had dropped without the Fed changing the Fed funds rate. Reason is the spread above the Fed funds rate can go up and down, right? It can move. And right now we have one of the larger spreads than we have in some time, and that's because there is an uncertainty about rates and a feeling that they may continue to even go up from here. And with the recent inflation numbers, I've actually heard more people talking about that. In fact, Larry Summers came out and said, Larry Summers has been on top of this the entire time.
Yeah.
Fed was saying inflation is transitory. Larry Summers was saying wrong. It's not transitory. It's going to be around a long time. He has been really on top of this. He's a former Fed director, and so he's a very smart guy. And he is saying that they may have to actually increase rates unless they reduce the money supply in order to get inflation under control, which the target is 2%. We've been a good bit above that. So what this chart is really talking about is the different ways that rates can come down. There are many. And if we do start to get some rate relief, they could come down. But I think what we're seeing in the market is that people are starting to get normalized with rates, and that there is the possibility that rates might even go up a touch. So if you're looking to invest, I would not be waiting on this big rate reduction. I do not see that happening this year. They may do a rate reduction closer to the election. That's a very common thing that happens around the election, but I don't anticipate many of them. And it may be as symbolic as anything because the last 3 inflation prints have not been positive if you're wanting to see a rate reduction.
Yeah, I was gonna say, I bet if you went back and looked at our webinars from late 23, talking about the likelihood of rates coming down in 24, but these inflation prints have been so high lately, that's pretty much killed the sentiment on that rates are going to go down. I mean, it may way later in the year if they get it under control, but to your point, there's a chance they go up at this point. So it's probably 50-50, to be honest with you. So, yeah, it's like, to your point though, it doesn't mean that we can go way back on the chart. I don't know if we have it, this one, the rate environment we're in, historically speaking, is relatively normal. It's not what it was 3 years ago. We're all hovering around 2-3%, but it's not 18 either, right? It's obviously the early 80s. It's probably a more normalized. I think it's probably about what it was like when I came into the business back in the late 90s, early 2000s. Like this is a normal market. It's just we got so recent bias on what's been happening the last 5 years. People forget that this is about what interest rates should be.
Yeah, I was talking with a guy the other day who bought a ton of real estate in the 80s. And he was like, all my friends thought I was nuts, right? Because the payments were high and the interest rate, that's 18%, that's an outrageous interest rate. It's hard to wrap your head around. But he said, I wish I had bought, every house I could potentially get my hands on, because once rates came down, I mean, the prices really, really went up. And I think that's what we're going to see too. So there's tons of savvy investors. The people who are buying right now, what I see for the most part, are usually people who either are going to mentorship organizations and they're being educated about the past, or they're the people who have already made money in previous environments, right? Like they made a lot of money back in 2007, 2009, 2010, whenever everyone else was afraid, or they're being mentored by people that are like that. So I do think that that's a big thing, is understanding that just because the environment does not seem perfect or the cash flow is not what it was 2 years ago, that does not mean it's not the right time to buy because of the potential appreciation that's right around the corner.
It's never perfect. There's always going to be something you don't like. Either rates are too high, or they cost too much, or rents are low, whatever the case may be. Like, it's never going to be perfect, but over timelines, it makes sense. For sure.
Absolutely. Next slide.
So this is I think I referenced this earlier. So this will speak to the lack of inventory that we have, or part of it, and why builders are trying to catch up. If you look at the orange line going from left to right, that's our population, and the blue line is the new builds. And as you can see, starting around 2005 with the great financial crisis, and really until now, even now, I bet it's still significantly below average relative to the past, especially when you take a look at the population. But there's only been a few times, like maybe in the early 80s, like we were discussing, where there's been the difference between the population line and these builds is great. They just didn't build enough houses over the last 10 to 15 years. And because of that, we're seeing the lack of inventory to begin with, coupled with population growth. And we talk about it every meeting, but it's legit. There's not enough houses right now.
Yeah, it's still so amazing to me that we're building fewer homes than we did in like the mid 60s. You know, definitely 70s. I mean, every decade, you know, we're building fewer houses. So it's kind of an amazing thing to see whenever our population is where it is. You look at the right-hand side on the population growth there, it's just really incredible. And then we're having more immigration than we have at any other point. So lots of opportunity for home price growth for sure.
And that immigration is, I don't know if that's included those numbers. Like it's not exactly it's not exact science on tracking that, right? It could be way more than you think.
Sure, for sure. All right, so the rental vacancy rate, this is a very exciting chart if you're a landlord. I mean, the vacancies are much lower than they've been in some time, and that's kind of the dynamic we talked about earlier. It costs twice as much to buy a home, right? So people got to go into rental properties. And you see that. When was the last time that vacancies were this low? Last time that rates were extremely high, right? And no, they're not extremely high now. Let me preface that. They were extremely high in the 70s and 80s.
Yeah.
12, 18%, extremely high. And then now that they're very low. So I think that is a very good indicator that rents are going to go up whenever vacancies are very low. Landlords can be more, you know, put pressure on prices, and that's what we're starting to see. It's just lagging. It just takes more time. All right. One of our favorite slides, the affordability index.
So yeah, if you look at this is the measure of income in a city relative to its mortgage payment. So how much was the average citizen, how much of their mortgage payment, how much of their income would go to the mortgage payment for them to live? Obviously, you look at Los Angeles, it's all of it. So I think people that are at that number or below are not buying a house. But if you look at, you know, the markets that we focus on, Austin, Dallas, Houston, San Antonio, Fort Worth, etc., way more affordable. Austin's making a little bit of a, I guess you call it a comeback. I don't know if it's good or bad, but it's creeping back up there, up to 17. $88,000 household income. Like Wade was talking about some of those Dallas suburbs, like Plano is 107. But you know, Dallas is 20. It was 25 a year ago. Let's see, I'm on my mouse. It was 20. So it's been relatively consistent. Houston, I don't know what happened last year. It was in the 40s, but it's back up in the 20s. And then San Antonio has been consistently getting more affordable, right? If you look down in San Antonio, it's all the way down to 69 at this point. So it's just a good reminder of how fortunate we are to be here in Houston, Texas, whatever, and how we have affordable housing with so many amenities still.
Yeah. You know, one thing that's interesting is that Houston, I was wondering why some of the movements, but Houston income from 2023 to now is actually down $2,000.
Oh, you're right.
Whereas
Austin's up, Dallas is up.
Yeah.
Yep.
San Antonio's down 3,000.
Yeah. I'd be curious what that is.
Not sure.
A little research.
Yep. Okay, so I think we're at a good spot. Derek, do we have any questions for today?
We do have some questions. I'll pull up the 2 questions as my camera loads here, but then we'll get to that drawing winner. But the 2 questions that came in, the first one says, based on the low down payment in Texas as compared to everywhere else, how should that impact your real estate investing strategy in Texas, being a Texas investor?
Well, I mean, it's a positive, right? You're able to put less money out of pocket into doing deals, so that's a real positive. I think that's the more dry powder, like we talked about, that you have, it's better. So if you can buy 4 houses instead of maybe 2 in other parts of the country, that's a real positive. Plus the cash flow is better. So I think it's just an attractive market. That's how it impacts it.
Yeah, and the down payment is a stat basically off the values, and the lower the values, just if you're a buy and hold investor, the lower the values, the more properties you can buy, the more efficient you can be with your dollars, you can cash flow. Or there's a lot of cities and states, they get so expensive you can't cash flow. So it's just an indicator that it's a good spot.
Yep.
Okay, and then the second question was, what are some key insights into how the change in inflation, basically the projections for inflation and what's now really happening? I'm sorry, I misread that. The projections for the interest rates and what's now happening with inflation, how should that change your investment strategy?
I don't know. Go ahead, Jeff. I'm sorry.
Honestly, the only thing I would say is, like, if you're buying a property, just understand you're probably going to be in the existing mortgage a little bit longer, because I know we talk about, if you're buying at a higher rate, the cash flow is minimal, maybe it's $100, something like that. And then, when rates drop, well, rents always go up. So that's going to increase your cash flow every year. But then if rates drop, you get to refinance and save a little bit of money. The only other thing is that it's going to be a little bit longer. Like the ability to refinance, you may have to project out another 6 months to a year of the current rates. Again, it's just a little bit longer timeline on the increases. That's really my only major takeaway. The good news is that I think the high rates are scaring people off. It's keeping them from investing. So while, yeah, your cash flow is less, you have less competition, we're still seeing good cash out of pocket deals, meaning like not as much, especially not as much as it was back in the COVID days when you're people dropping 35, 40 grand, like on average. It's way less than that right now. So I think it's keeping people away. You just got to plan for a little bit less cash flow in the immediate.
I'll make one other point before we wrap up. A lot of people talk about they are wanting home prices to drop before they invest. I hear some maybe novice or less educated investors say in that. And I'll make a couple points on that. One, I don't think it's going to happen if if home prices haven't come down in the current rate environment. It's unlikely that they will, unless some other major event were to happen. But honestly, you don't want home prices to drop in almost every scenario, because you might own some other properties, but even more so, that's not going to change your out of pocket. What changes your out of pocket on a transaction is that you're able to buy at a greater discount to the value. And that is what's happening right now, because people are overly fixated on cash flow. So for example, Jeff can tell you our average deal coming through the door whenever rates were extremely low is probably 92.5%, 90% of the after repairs value. And now it's far less than that, as much as probably 12.5% less, right? So that means that your average out of pocket from that time frame is about half of what it was back then. You can never change your out of pocket, but you can eventually change your rate, and you can eventually change your rents, right? Rents do continue to go up. So I think that's the biggest thing, is that right now you're in a unique situation where the out of pocket is very low because you're buying at a bigger discount to the market, and you're not having to wait on some potential home price drop, but then you're still going to be out of pocket at a very high number if that were the case and rates were low. So yeah, overall, I think it's You're not waiting on something outside of your control. You're taking control now and able to invest.
That 10% doesn't sound like much, but that's a huge deal if you think about it. The average ARV is 200. If you're used to buying properties at 90, now you're getting them at 80. That's 20 grand. That's $20,000 out of pocket right there. So like, don't sleep on that 10%. That is a massive difference. That's the difference of buying 2 houses versus 4, if you look at it that way.
Absolutely. All right. Great job, Derek, on putting together the presentation. We really appreciate it. Thank you, Jeff. And hopefully we'll get Stephen Curtis on a call very quickly to talk a little bit about what he has. And then we do have to announce a winner.
Yep. And we have a winner. We have half off their next hard money processing fee is Scott Bernstein. Scott Bernstein.
Big up, Scott.
Yeah, congrats, Scott. Look forward to doing that deal with you. Thanks, everybody. Happy investing. We'll talk to you.
Thanks, guys.